Retail trading has entered a new phase, with thousands of independent traders abandoning standard technical analysis to mimic the financial giants. These traders are following a framework called Smart Money Concepts, or SMC. The promise is simple: the ability to track and trade alongside the massive capital flows of global banks and hedge funds. This movement is sustained by the claim that a specific interbank price delivery algorithm, the IPDA, governs every price movement on the chart. Data from retail accounts using these strategies shows that win rates and risk-to-reward ratios remain strikingly standard. Despite the proprietary names, the performance metrics of SMC practitioners typically match the baseline of the broader retail population. A retail trader utilizing a secret Tier 1 banking algorithm should theoretically produce returns that detach from the average. When the aggregate returns mirror the retail baseline, it suggests a gap between the marketing and the mechanics. True institutional trading operates through a multi-million-dollar infrastructure. Banks utilize prime brokerages and direct fixed API connections to execute orders in milliseconds, far beyond the reach of consumer software. At this level, profit is generated through high-frequency market making and statistical arbitrage. These firms deploy massive capital to capture micro-fluctuations in price, relying on mathematical models rather than visual chart patterns. There is a physical disconnect between a server farm executing thousands of trades a second and a retail trader manually drawing zones on a 1-minute candlestick chart. Because retail traders lack the capital and speed to interact with the market like a bank, we have to look closer at what these popular SMC strategies are actually teaching. Much of the smart money framework relies on taking traditional trading principles and giving them a new, proprietary vocabulary. This breakout is an SMC breaker block, but in standard textbooks, it's just support turning into resistance. A market structure shift and fair value gap map directly onto a classic head and shoulders pattern, and low resistance liquidity runs are simply elementary trend trading. This complex vocabulary creates an air of exclusivity, making simple retail mechanics feel like institutional secrets. Creating this layer of jargon requires significant effort, but it provides a massive financial incentive for content creators. YouTube income is largely determined by RPM, or revenue per mil. This metric tracks how much a creator earns for every 1,000 views, based on the value of the advertisers in that niche. While general entertainment pays a few dollars per 1,000 views, finance channels command a massive premium, reaching $15. Teaching complicated systems forces longer watch times and frequent rewatches. This increased retention multiplies the total ad shown, turning a single viewer into a high-revenue asset. These channels capture the high-value ad revenue at the center of the YouTube ecosystem by converting educational complexity into extended watch time. Retail orders are too small to create market impact or absorb liquidity, making it physically impossible for an independent trader to move like a financial institution. However, these strategies still provide value to the traders who use them, even if the institutional branding is an illusion. The complex rules and checklists of SMC act as a forced disciplinary layer. By requiring a trader to wait for highly specific conditions, the system prevents the impulsive entries that usually drain retail accounts. This methodology functions as a psychological guardrail, building the patience and risk management necessary to survive in a high-risk environment. This entire ecosystem is built on 3 layers: the institutions that move the market, the retail traders seeking an edge, and the creators bridging that gap. Many faceless channels now automate this exact process, generating tutorials and market commentary to scale ad revenue and affiliate commissions without ever placing live trades. The path to profitability in retail trading remains unchanged, mastering personal psychology and strictly adhering to a risk management plan. In this environment, the content creator captures the most consistent returns by successfully arbitraging the YouTube algorithm's highest-paying niches.